Assessing risk is all about figuring out the downside. How much do you potentially stand to lose in a given stock? How far it can conceivably fall in the near term? Assessing the reward, on the other hand, is all about figuring out the potential upside. How many points of gains the stock could reasonably give you? Too many people only focus on the upside when they evaluate a stock. That's a grave, grave mistake. It's much more important for you to understand the risk side of the risk reward, because the pain from a big loss hurts a whole lot more than the pleasure from an equivalent size gain. Remember, the losses, it's the way our brains are wired. The losses just hurt more, and they do tend to blind you. So how exactly we figure out this risk-reward thing I'm talking about? Okay, these are determined by two different cohorts of investors. The reward, the upside, is defined by how much growth-oriented money managers could be willing to pay for a stock. They create the ceiling. The risk, the downside, is created by what value-oriented money managers would be willing to pay on the way down, and they create the floor. I am, yes, oversimplifying to a degree, but I got to get you to understand this stuff. To figure out the risk, you need to consider where the value guys might start buying on the way down. To solve for the reward, you have to think about where even the most bullish of growth guys will start their selling. Sell. When asked, I usually boil the risk reward down to something quick and dirty, like 5 up, 3 down. But how do I get there? How can you know where growth money managers will start selling and where value guys will start doing their buying? Okay, to do that, you need some insight into how these guys think. And that requires translating another piece of esoteric Wall Street lingo: growth at a reasonable price, a.k.a. GARP for short. When we talk about growth at a reasonable price, that's not a subjective criteria. It's a method of analyzing stocks first popularized by the legendary money manager Peter Lynch by comparing a stock's growth rate to its price-earnings multiple. If you want to figure out the maximum that the growth guys would be willing to pay for a stock, you need to be able to look at the world according to GARP. You want to learn more from Peter Lynch? Go to Amazon and buy One Up on Wall Street, and Beat the Street. These are two most important books on investing that anyone's ever written. I've read them both many times. When it comes to growth at a reasonable price, here's my quick and dirty rule of thumb. A rule that can help us figure out when a stock is overvalued or undervalued based on what these two groups of money managers would be willing to pay for the stocks. Let's say a stock has a price-earnings multiple that's lower than its growth rate. Then that stock is probably cheap, although, of course, there are always some major exceptions. Flip side, if the price-earnings multiple is twice the size of the growth rate or greater, well, I think you should probably sell it. Again, I think. And that's because there are exceptions, and there's some people who are more aggressive than I am. In other words, if something's trading at, say, 20 times earnings, and the stock has the company has a 10% growth rate, then it's likely at or near its peak because it's reached the 2 times growth ceiling that I regard as a safety zone.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com. Or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.